Hi, Joel Martin with Fairway Independent Mortgage, Fairway's first team, back at you again. We're kind of getting a little deeper into those 4 C's that we talked about yesterday. So the second C that we're going to talk about a little deeper is kind of the capacity stage, and we're going to deal mainly with loan programs. So there's kind of 2 different types of loan programs you're looking at when you're buying a house. One is FHA and one is conventional. So the 2 different categories that we're looking at are we split them into credit scoring basically. So a 600 to a 680 credit score is going to get you into an FHA program. An FHA program also requires a 3.5% minimum down payment. There is an upfront mortgage insurance premium that gets rolled into the loan and a monthly mortgage insurance premium to protect the investor in case of foreclosure, but that is also included in your payment as well. So with the FHA loan as well, we can go to a 55% debt ratio, and what that basically means is when we're calculating your debt ratio, we're looking at your house payment, all of your credit card and car payment debt, student loans, and dividing that into your gross monthly income. When we do that, we want to see it at 55% of your gross monthly income or less. So if there's 2 people buying a house, we're looking at their total income combined and then adding all of their debt, all of their mortgage payments into that income to come up with the 55% debt ratio. The other side is conventional. Conventional also with 3% down as the minimum. Credit scores range from a 680 and above up to the cap of 850. And you've got the 3% down payment, and then you've also got mortgage insurance as well. Now the difference here with the mortgage insurance is after you have 20% equity. So equity is basically the amount that you owe to the amount the house is worth. And when there's a 20% gap there, you can actually have the mortgage insurance removed, whereas FHA, it's for the life of the loan, which means you'd have to refinance the FHA loan into a conventional loan to get rid of the mortgage insurance. But you can have that mortgage insurance with a conventional loan taken right off the loan once you have that 20% equity. The other difference with conventional is your income to debt ratio is a 45% or less. So those 2 loan programs are what we basically look at to have you qualify to buy a house. There are some other subsets of those loans. There's a Chenoa loan, which is 100% financing. And then every time you actually increase your down payment on conventional, your mortgage insurance actually reduces as you kind of go through. So if you have more questions about loan programs, my number is 503-807-7804, thenwmortgageguy.com, and Joel Martin at Fairway Independent Mortgage. Thanks again.